So friends, let's start with some industry talk with the eminent women professionals that have joined us here today. Our first discussion of the day is redefining real estate for attracting new age investors. And the session will be chaired by Mr. Gautam Saraf, Managing Director, Mumbai, and New Business India, Cushman and Wakefield. In more than 15 years of service at Cushman and Wakefield, Gautam has been instrumental in growing the firm's revenue multifold with innovative service offerings for occupiers as well as investors. Besides serving as one of the founding members of agency leasing business for Cushman and Wakefield in India, Gautam was also instrumental in revamping the retail as well as logistics business. Mr. Saraf, a very warm welcome to you. Let me now introduce our speakers in an alphabetical order. I welcome Ms. Anjana Sastri, Director Marketing, Sterling Developers, who directs the marketing efforts of the company. She bears her MBA degree from the University of Michigan Ross School of Business with her in-depth understanding of the marketing tools used in real estate to deliver unique campaigns. She looks into the sales vertical of the company and assists in sales strategies. Anjana is currently the Credi Women's Wing South Zone Secretary and also on the Credi Youth Wing Karnataka Core Committee. Our next speaker, let me welcome Bani G. Anand, Vice Chairperson, ATS Infrastructure Limited. Bani plays an instrumental role in daily cash flow management through sales and brand communication, while also handling large financial transactions and the company's legal departments. Bani is also the founder of All About Eve, an online content-driven portal that is aimed at helping women make informed decisions. Our next eminent speaker is Ms. Hina Kamra, Managing Director, New Wealth Management. Hina Kamra is a multifaceted professional with over 27 years rich experience in the banking and financial service sector across multiple assets. She has been in real estate financing for over 12 years and has held the post of Executive Vice President in Edelweiss Alternate Asset Managers Limited, as Fund Manager, Edelweiss Real Estate Opportunities Fund, and was part of the investment team in Edelweiss Real Estate Fund, ICIF, etc. Our next speaker, let me introduce Ms. Khair Nissa, Executive Director, WTC Services, World Trade Center, Noida. Khair is spearheading the World Trade Center services and tenant services of World Trade Center Noida. She is responsible for forging new strategic partnerships while maintaining old, and her main responsibility is identifying new opportunities for revenue growth and instituting and implementing long-term and short-term plans and strategies. She provides inputs on potential executions and new developments, critically analyzes current operations, and cascading them respectively. Next panel member for this session is Reshmi Panicker, Executive Director, Land and Residential Services, Knight Frank. Reshmi, with over 34 years of experience in leadership positions in top companies, has handled major projects and key competencies in business development, land management, handling projects, sales, and customer relationship management. An architect from IIT Kharagpur, she has been responsible for setting up business verticals and establishing key processes. Our final panel member for this session is Ms. Sarah Jacob, Director, Trine Holdings. Sarah has done real estate management program from IIM Bangalore and has over 20 years of experience in consulting and real estate development. She worked over a decade in MNCs like Accenture, IBM in Central London, and moved to India in 2010 and has worked on residential, commercial, hospitality projects. She's also actively part of the Credi National team and is currently the Credi National Secretary, Women's Wing 2023-2025. So this is our eminent panel. Our discussion is for 1 hour. Mr. Saraf, let me hand it over to you now.
Thank you, Sapna. Excited to be part of this power panel, redefining real estate to attract new age investors. As most of us saw in the previous decades, the age-old investors, which were the banks and the NBFCs, had kind of slowed down. The post-IL&FS crisis, we had NBFC funding literally stopping. The new age investors, which came in the form of private equity investments, sovereign wealth, the space has been significantly growing. We also have evolving segments, which is the organized space for ultra HNI institutions, in form of REIT, and very recently the fractional ownership of real estate in both commercial and residential assets. the demands for these new age investors has been beyond the economic returns, where they have been looking at more of socially responsible investment. As most of you would know, the built environment constitutes about 40% of carbon emission. So from a greenhouse emission perspective, there are corporates that have been setting up science-based targets, which is directly and indirectly impacting the planet with the climate change. PropTech as an asset class has gained significant traction in real estate, making it a little bit more liquid than it used to be. Sustainability's significance across the commercial asset classes today has stakeholders industry make a concentrated effort for reducing carbon emissions through these science-based targets. Green buildings are likely to attract market tenants and investors, which is a given today. And we have about 22-23% of India's overall grade A stock across 8 cities, which are classified as green and LEED certified. Best-in-class amenities have elevated the office experience, presenting attractive investment opportunities. And again, in the residential space, post the demonetization and RERA, we've seen institutional capital coming in. With that and this exciting panel, I would like to start with Anjana, who's been the face of Sterling Developers for years together, won a lot of accolades. I was going through your profile and just wanted to ask you in terms of what kind of properties today attract the real estate investors in the residential segment.
Thank you so much for the question, and good afternoon to all of you. I'm very glad to be here, and I hope we have a great discussion together. So going back to your question, I think, like you rightly mentioned, what's happened in the past few years is that a lot of investors and customers, both alike, have been looking at the sustainability lens quite a bit. So that is something that has gained a lot of importance over the past few years. And that sort of also propels a lot of projects into having or accommodating far more green spaces and open spaces for investors and customers. So what we're seeing today is that customers coming in are not only looking for homes that are multifunctional or have living spaces that are multifunctional, but are also looking for communities that serve not just the basic amenities, but an elevated set of amenities, which can help them almost be self-sufficient within the community that they live in. So I think that is something that has become very, very important. Location was always an important factor, but I think, like you said, post-COVID, people have realized being closer to offices, hospitals, your grocery stores and schools is something that has also become very, very important. But what we are seeing for sure is that people are not just looking for a home anymore. They're looking for a community. They're looking also for spaces within the home that they can design flexibly, which may or may not have been an option earlier. And they're also moving into looking for the entire community being at an arm's length. So I think both customers as well as investors, because the investors are also realizing that investing in projects like this is what is bringing a far more return than your typical, single building projects. So I think from that perspective, it's sort of two-pronged. It's multifunctional space and a community that both customers and investors are looking for.
Excellent. Thank you, Anjana. Let me bring in Reshmi, 3 decades of experience, and good to see you, Reshmi, after a long time. Just wanted to understand, what have you seen as an evolution over the last 3 decades, and more importantly, pre-COVID and post-COVID in this segment?
Surely, Gautam, thanks, and good afternoon, everyone. I'd like to talk about the 30 years that I've been in real estate, and I've witnessed the transition of what real estate was many years back and how we really transformed in the last 10 years. Post the pandemic, post-COVID, and post the different requirements, set of requirements that customers have. Now, on an individual level, like Anjana mentioned, we are really seeing a lot more preference for larger spaces with multifunctional areas which can be used for home, working out of home, office space, etc. There's also a preference for integrated townships and gated communities, which offer not only residents, but a whole lifestyle for all age groups, right? From children to elderly, etc. It also provides a very secure environment, and you also have a lot of amenities and facilities within the premise which allows you to enjoy a good lifestyle within the confines of your complex. So that's another aspect that we've seen, which is a growing demand and a preferred area to invest in. The third part that we're looking at is second homes. Now, with COVID and the pandemic, a lot of people have really changed the way they look at life and work. So today, it's not about a work-life balance. It's more about a work-life integration. They also want to spend more time, and with the help of technological advances, a lot of people are, can operate remotely. So they're really looking forward and looking out to buying second homes in peripheral areas like Alibag, Goa, etc., and operating out of that. So you're seeing a growing need of second homes, which have risen in the past couple of years. Now, on an institutional level, you find that the technology has allowed us to, if you take a step back and look at how real estate has been for most consumers, it was unaffordable for many. It was also illiquid. And for the younger generation, it was very difficult to find rental housing. And today, with the advancement in technology, you're finding that you have new age concepts of investments like fractional ownership, co-living spaces, student housing, and REITs, which allow you to own properties, be it commercial or residential, at a fractional cost. And you're also you can experience all those benefits without owning a property completely and spending a lot of money on it. So I'm seeing a lot of opportunities in the new age investment modules that have come out. And while it's still in the growing and nascent stage, it's definitely going to mature over the years to come. And there is a good demand for all of this.
Thank you, Reshmi. This gives a perspective of, like you mentioned, in terms of liquidity that is coming in and various other sources of investment that even developers are looking at from an investment perspective. Let me bring in Hina. Ex-Edelweiss now with new growth has done about $700 million of fundraise in the past. Hina, what's your view in terms of new models of funding that's being developed in the market from a developer perspective when they look at acquisition of land or even construction?
From a developer perspective, obviously, there is a dearth of available capital in the sector. So any avenue is welcome. So while initially it was more, bilateral arrangements and, more of an understanding, over the last 2 decades, the institutionalization has been growing. But before we come to that, I think let's first define who is the new age investor in real estate. In Indian real estate, we are talking about more global institutions. More global institutions, probably more with an ESG bias and an ESG focus. You also mentioned something about green buildings and also.
Right.
While predominantly we're seeing it in the commercial sector, commercial real estate and I guess logistics, because that's where a lot of FDI is coming in. Slowly it will percolate to the other sectors also. Then second is the large multi-family offices. These are family offices anywhere with a corpus of anywhere between rupees 1,000 crores to almost 60 to 70,000 crores, which are run by professionals. They are run just like large institutions. Then third, we're seeing more of control and more of investors from Generation Z, millennials, as well as women. Now, if you look at the data points, globally, 33% of the AUM of wealth management is actually controlled by women today. So this is an interesting data point. So, sorry, it's not globally. I'm talking about North America. Now in India, when I talked to my peers and I was finding out what are the stats in India, in ultra HNIs, also it is close to 30% today. So women are an important, very important segment. Question is, are they underserved or are they being well taken care of? 4, in terms of the new age investor, what are their attributes? They're all digitally savvy investors. They all have a preference for liquidity, transparency, governance. They like multiple options, which is why, alternatives have been growing. There is a lot of focus on asset allocations and having a policy in place, more of a portfolio approach. So while, I would say the preference for hard assets still remains globally as well as in India, financialization of savings has started even in India. The best example of this is actually mutual fund industry, which started off in India in 94 and today is worth an AUM of 41 lakh crores. If we talk about AIFs, which includes real estate, venture capital, private credit, everything, the works. Today, that industry has an AUM of over 7 lakh crores. And the growth is almost 45% over the last 2 years. So clearly, the preference for instruments is actually growing, and which is why the forms of investments are also changing. For instance, in the last few years, if you talk about, let's say, Indian real estate between, let's say, 2000 and 2010, that's when the true institutionalization actually took off in a big way, both with respect to developers as well as to the forms of funding. So on the funding side, you had FDI which came in, you had IPOs which started happening, you had banks who got into housing finance. And on the developer side, you had IPOs, you had slightly larger scale of projects because you had access to more capital. Between 10 and 20 is when the true takeoff happened. You had AIFs, which were launched in 2012. You had the growth of NBFCs, another platform for credit disintermediation. Then you had regulatory changes with respect to RERA, demonetization, REIT regulations. And hence, you had the REIT issuances that happened. Again, REIT itself is the outcome of financialization of Indian real estate. So more and more of this will come along. And as more of this comes along, obviously, I find the Indian developer very flexible. So there is a dearth of capital. They're happy to experiment with new instruments, whatever appeals. In early 2000s, it was equity. Before that, it was more of private capital that was coming in.
Right.
And they've been quick on the uptake between 10 and 20 also to adapt. The idea is to attract more and more investors and to make the industry, full of more of a regulated industry, which can be actually governed. The other part is that if you talk about how can new instruments, capital market instruments come into this particular
let me come back to you. I just want to ask Bani a question related to REIT, since you brought in REIT as a new liquid asset class that has kind of come in, which is the instrumentalization of real estate per se. Bani, as ATS, one question is also that we've, Hina mentioned that while ESG sustainability has come into commercial real estate, but at ATS, we saw a lot of developments which were sustainable in nature in the residential space. And most of your projects are named like Happy Trails, Floral Pathways, orchards around it. So can you throw some light on that? And then probably on the REIT also in terms of, it's gained a lot of momentum recently. So what is attracting the investors here, though they haven't given the returns one would have anticipated yet?
Yeah. So speaking of course, starting with the whole point of danger, I think my father, I'm going to praise him a little and say he's been a visionary. We actually operated in silo entities even before RERA. And I think it was his vision, about building sustainable green projects from the very start. So actually our first project was just called ATS Greens, because his idea was, where would I like to see my kids grow up? There should be a swimming pool, there should be greenery, old people should be able to take a walk, children should be able to play. Is this the life that I would want for myself and my children? If yes, then that's what I'm going to build. So we are actually developing a Miyawaki forest also. We are very, very sort of bullish, or have been, in terms of, how clean can the air around you be? Of course, the NCR is extremely polluted. So you want to be able to make the best of that. There's only so much we can do. But I think that has been one of the selling points of, sort of our projects. It's that they've not been extremely high density. We've not been supremely greedy that way. And they've been very sort of high on green development. And everything that we've built in now has lasted. Our project ATS Village, which was right next to the project that actually got demolished, with the grace of God, had no cracks, right? Because it was a well-made building. And I think that was the idea. So we've obviously kept our focus on residential real estate. That has been sort of our primary portfolio, but we have diversified into commercial real estate also, and primarily with the objective that at some point in time, we are going to have, a REIT of our own as well. I actually studied about REITs when I was doing my master's in real estate finance back in 2012, 13. And I remember at that point in time, studying the American, European markets, and what they were in the 60s is pretty much what we're replicating now. Statistically. So, the next thing that we will have possibly are going to be, we already are talking about fractional ownership. We're talking about real estate derivatives, and that's how real estate will be traded primarily, because in urban cities, people, if you see statistically, at least in our sort of, sales data, we've realized that the average age of the buyer has gone up from 31 to 34. So, in the urban cities, where people are digitally savvy, and there's no touch point to payment also. You don't know how much you're paying even, because you're either using UPI, you're making contactless purchases, so you're automatically saving less, which means that you are going to take longer to buy what you're buying. So that is one observation that we've had. And secondly, it has made me think about whether at some point in time in urban India, residential REITs a possibility, because we've only thought from the perspective of commercial REITs, and in Asian countries, residential REITs have not performed well, whether that's Singapore or Japan. They failed because the Asian sentiment is always home ownership. But as, fintech is evolving, and as the average age of the buyer is going up, and as more and more people in urban India are choosing not to have children, will the idea change? Will we want to have residential REITs at some point in time is something that I do wonder about. But I think that we're living in a country where, inflation rates for the most part are higher than what, bond returns are giving us. So technically you're losing money. And real estate has also gone through sort of a bad slump for the last few years. I would say pretty much since 2018, but it's picking up now. So I think the liquidity of being able to trade it on the stock exchange and not have to wait for a buyer to come through a broker and then buy such a large sort of, asset, a large investment. If you can just make a small investment, take the risk of real estate, which is medium, get the return of, that you would get on equity, which is high. I think it's a very attractive option for younger, savvy investors.
Agreed. I think opportunity to participate in real estate without a large amount of capital. Let me bring in Khair, Nissa, from Kashmir to Dubai to Noida, and I don't know how many World Trade Centers, probably 35 now?
35, yeah.
35, right? So congratulations on that, and congratulations on winning even the top 50 Global Inspiring Women Award for 2023.
Thank you, Gautam. But currently I am in Saudi. I'm actually working on a project which I believe most of the people, one of the most talked about global project, NEOM. So I've been assigned this role.
Wow.
So I'm here in NEOM.
It's a mini city which is getting created, which will be traffic free and right.
It's a huge, I would say, a country in itself getting created in Saudi. I mean, it's got, we've heard about the Lion, but other than the Lion project, there's an archipelago and there are 39 islands. So I am I'm actually working on this project for World Trade Center. So I've been assigned this job. So this year onwards, I am here. But I'm also part of the Asia Pac of the World Trade Center. So in which India is my country, and my major focus would always be India.
No, that's nice to hear. Just wanted to understand your view. Bani was talking about the fractional ownership of real estate. CV came out with a paper right now wherein they're asking for comments, and there are a bunch of fractional ownership of real estate that exists they've been able to buy assets and I think garner upwards of 1,000 crores of assets, wherein retail participation can be as low as 10 lakh rupees. So
Yeah.
what's your view from in this sector? Will it lead to commoditization? Will it lead to bloodbath? I mean, just
See, I think in India, especially when we are looking at real estate, which is the largest contributor of the economy, and we Indians love our investments in real estate besides gold. So I think real estate would always be the ownership that we like about real estate would always stand true. As far as fractional ownership in India is concerned, I think it is in a space we're in a space where it is going to evolve majorly, and we are going to see this evolution in this largely because there are a lot of advantages in fractional ownership that fractional ownership offers. I mean, increased accessibility. You get a wider range of investors. There's advancement of technology which is happening. There's a rise in the digital platforms which are going to be making what you're going to basically facilitate fractional ownership transactions, and the structures are going to get evolved. It's a great opportunity, I believe, which is offering or which will offer diversified opportunities, different locations, different asset types, and this diversification would largely mitigate risk and enhance investment returns. We've seen that, gone are the days when an investor was based only in Noida, would only invest in Noida projects. Now we've seen that people globally invest. I mean, Indians especially are investing in the real estate, but then we're going to be opening up a lot of opportunities of diversification with fractional ownership. Then there's going to be a rise of specialized fractional ownership platforms, which are going to be, streamlining the legal framework, solutions, and there's going to be a whole lot of advancement in this space. We would see an evolution in terms of new investment structures. There's going to be, we're going to be moving beyond the traditional property ownership structures. Innovative models will emerge. The shared equity arrangements would be something that we would see. There would be flexibility and an alignment with the value appreciation of the property. But obviously, the regulatory framework and standardizations is something which is going to develop and which is going to help and accelerate this evolution. We are already seeing an integration with the blockchain technology, and in India, we're seeing that this blockchain technology would help in improving and providing transparency, efficiency, security in managing the transactions. Hina did talk about the portfolio management, which we are seeing in reality happening, and that is something that I believe that fractional ownership would really, really help and be a catalyst to this portfolio building.
thank you.
That's what I think. It's a time for evolution.
Yeah.
May I say something? Sorry,
Yes,
I would just like to interject on this because it's a very interesting topic. I feel conventional real estate, the way we operate and sell today, who we sell today, is just a 15-year game. I don't see it going beyond that, because as the cost of material goes up, as the cost of land goes up, it's basic math, right? We are now unofficially the largest population in the world. We are only the 7th largest in size. So there is only limited land. So at some point in time, you're going to be able to not match the prices that people are asking for that land. Which means that where does it go from there? Also, if you see with the evolution of AI, people are going to lose jobs. And also with the evolution of the internet and internet reaching now villages, because when we talk about real estate, we limit it to what urban cities have to offer. Our real estate understanding is Delhi, Mumbai, Bangalore. But if you're looking at real estate, then so much of it is tier 2, tier 3. And today a tier 2, tier 3 person is more excited to actually buy an iPhone because it gives them an opportunity to monetize themselves on the internet. So are they going to be interested in buying real estate 15 years from now? I am not sure, which is why I agree that, structures of investment will change, which is why I agree that the nature of investment will change. We will not be saving as much. The youth is not saving as much as it was across the world. And how are we going to then, are we in fact even looking at perfect ownership of homes 15 years from now? I'm not entirely sure.
Bani, I would agree with you on that. In India, when I look at, from my experience in India, I've seen that the largest investments that we have seen coming in the World Trade Center has been from tier 2, tier 3 cities, largely because it's been more aspirational, because they want to have something which is aspirational and own ownership of, aspirational and make it as aspirational investments. We have also seen, we are actually seeing a marked change in investments globally when it comes to that no longer is the traditional real estate being looked as, how in coming times we would see that happening. I mean, I'm seeing already, like if you look at warehousing, in the space of warehousing, I mean, we are seeing global investors which are actually looking at the combination of, owning the real estate and having investments and taking exits and a faster exits being looking at. So yes, the investment behavior is going to be changing. And it is not only when we are talking about the new millennia, but we're also talking about seasoned investors or institutional investors, their behavior also changing over a period of time. And AI technology, these are just means to those investments. But what exactly is the investment? What is the diversification that those investments are offering, and what is the risk mitigation that is being taken care of, in addition to the basic fundamentals of investment, which I always say is the power of 4, which I say is 4, is that security, appreciation, and return on investment. And an investor would always be looking at these aspects, no matter what we talk about, whether they're traditional or new age. They would always be looking at security of their investment. They would always be looking at an appreciation and a return on investment. And if it is with a credible developer or a credible property or management, they are doing away with this fractional or with portfolio management, the wealth management, as we call it.
Quite interesting. Khair and Nissa, I'll bring in Sarah, who's done some developments in these tier 2, tier 3 markets, and of course commercial assets in Bangalore, and of course award-winning resort too. So Sarah, what's your view in terms of what are the investors looking at in a commercial real estate when they're doing investments? Because of course Bani feels that the concept of ownership will change for 15 years, and there of course a lot of conversation around the tech disruption that will happen.
Hi everybody, good afternoon. So when investors look at commercial real estate, the asset classes could range between a retail, office space, and a hospitality warehousing. And this could be at a greenfield, a brownfield, and a rent yielding asset. Okay. So let's look at the investment strategies, what goes into an investor's mind. I'm quickly going through some of these investment strategies for commercial real estate, starting from the least risk to the high risk. Okay. The first one is the core investment. So basically what they do is they like to buy out the highest quality of asset, which will have the lowest yield. Okay. But it is very safe. So example, you buy a JW Marriott, the risk is very low because the product is at the best condition, and the seller puts in at a very high price. But the yield at the end of the day is low, and that's proportional. The next one is the Core Plus. So which means you take a B class building and you want to upgrade it to a B plus category. Right. And you're trying to upgrade it into a higher grade, which means like a 55 rupees, and you're increasing it to a 75 rupees. So the investor does see some sort of a increment. And then there's a value add where you actually take the C class and you try to make it into a B or an A by renovating it. There is risk involved now. And when you look at an opportunistic, investment strategy, it is basically a distressed property where actually they buy small assets where the risk is attached to it. And say Blackstone does this, okay? And they buy small industrial buildings around the peripheries of the cities. And they, what they do is they buy about 10 to 100 of such properties, and then they group them together to create a portfolio, and thereby creates value out of it. And then it becomes opportunistic. Then there are distress. That means the financing mix is wrong. They've lost their large tenants, and if the building is actually in trouble, then you buy it at a very low price. So that allows you to upgrade, and the investor makes money eventually. But the best one is the greenfield and the development, where you actually buy a building and you knock it off and you actually start from fresh, or you pick up a land and you start developing it. So, but what are investors actually looking for? They're basically looking for locations. Obviously, the supply and demand of the locations come into play, and the study of the micro markets, the road expansions or the metros, and all of that come into play. And say, suppose like Mumbai. In Mumbai, if I pick up a building in the center of the city, it is actually good, because there is no chance that a competitor is going to come in with a new building next door, and it is not easy to get permits, okay? And then there's this sector which are resilient. So basically cities that have mixed use industries and old time money that is there. So that's very safe. Investment horizons and investment returns. So basically there are private investors. They look to take total returns for about 3 to 7 years, and then they want their capital, but also along with some mixed income. And then institutional investors, they prefer like evergreen capital, steady yield, all of this. And then the office spaces which have the long-term lease, whereas the retail has the short-term, but then they have higher appreciation because of the short-term lease that they have. But let me tell you, beyond all of this, more than the location, your tenant mix, your financial performance, your valuation, or your lease term or the cash flow, if it is a new age investor, they are looking beyond all of this. He's looking at potentials of the builder and the developer to deliver. The builder's potential to bring out an attractive product and a niche product to the table, and the builder's ability to incorporate sustainability, layers of sustainability and ESG metrics, very important. And a commercial real estate that's definitely going to, yield a higher return of investment. Yeah.
Now, let me, Saraf, bring in Reshmi. 3 decades, at one point in time in Mumbai, she was called actually the land queen, because she did most of the land trades, and one of the rare ladies who was in the real estate space in land. Reshmi, what are the emerging asset classes where investors are looking to deploy their capital in it? And what is driving this investment decision for them?
Right. Gautam, over the last couple of years, there has been a subdued interest in investing, PE investment in India. It's fallen by about 17%. 2021 was not a great year. Having said that, I do feel that there is good interest and demand for data centers, logistics, warehouse, and core retail and core commercial. So these are here to stay. In fact, residentially, we found a great dip last year. It was only 12% of the PE investments that were made in residential real estate. But we hope, and that was primarily because of the high interest rates. And commercial has also declined, but not by that much. But there is very growing demand for warehousing, logistics, data centers. We're seeing a lot of transactions happening in that space. And I think that demand is going to continue to be there over the next couple of years.
Interesting. So quite a lot of diversification in other asset classes that's happening. Anjana, let me bring you in terms of the query. There was an aspect that I think Bani spoke about, Sarah was talking about the greenfield development, but what about existing buildings which are there? What are developers going to do to make it compliant to ESG and sustainable for it to remain marketable?
Sure. So I think there has been a shift if you look at just the broad spectrum of real estate across the country. And developers are realizing that whether it was projects that were done or projects to be done, or like Sarah said, if you're purchasing, say, a property and either redeveloping it or upgrading it, I think the focus definitely has been to try and see what can be done to be more compliant, but at the same time also be price sensitive to the customer that you are attracting. Because sometimes what tends to happen with all of this is when projects are very heavily focused on being very sustainable, or being very conscious, what happens is there is a price increment that we may not necessarily immediately see, but when you calculate it down, it does happen, because of course it is slightly more expensive to do all these things. And what we have to realize, and very like rightly said by Bani, 15 years from now, people may not even want home ownership as an option, right? So how do we maintain the price to remain competitive today while we're upgrading or being compliant with what we do? So I think a lot of developers are going step by step. No one is necessarily jumping the gun to try to tick all the boxes, because honestly, it's not as easy as it sounds, right? And there is also a lot of capital investment that goes into upgrading or meeting these standards. So I think what developers are doing is they're breaking it all down. They're breaking it down into some of the aspects that are easily achievable, that may not require a lot of capital investment upfront. So they're starting with that, and I guess over time they will build up all the way to the top. And there are developers that are already doing it. When people are starting new projects, they're trying to sort of ensure that they've got all of it covered. But for some of them, and say, for example, like us, we have 3 ongoing projects, right? So for us, it's almost going back to the drawing board and thinking at this stage, what can we do to incorporate,
Wow.
newer features or sustainable features, or at least make sure that we're within the framework of what's been laid out. So it does involve a little bit of tweaking, a little bit of re-strategizing. In some cases, it may not even be possible. You're probably at a stage in a development where you cannot go back to the drawing board or cannot accommodate. But I think the whole idea is, as far as possible, if as developers we're thinking about it, and we're trying to incorporate it while also being price sensitive, I think that's sort of the only way to go forward from here.
Tough one to meet both price sensitive and sustainable targets.
Yeah.
No,
Gautam, I just wanted to add that regarding corporate developers who are in it for the long term, they do realize the importance of ESG and achieving net zero. Right. And we do have certain very prominent developers who are not only embedding this carbon net zero and ESG compliance in the new buildings, they also retrofitting their old buildings to be ESG compliant. And either by reducing the energy efficiency, improving the energy efficiency, putting solar panels, achieving that net zero, composting, rainwater harvesting, all of that are being done in the older buildings as well. So I do find a lot of leading commercial real estate players doing that, and they know that in the long run, that's going to be imperative if they want to have a good valuation of their properties.
No, couldn't agree more. Empire State Building, probably built in the 1970s, is a classical example, which is 100% running on renewable energy now. Hina, you wanted to say something?
Yeah, I was just reacting to Bani's interesting point that, 10, 15 years from now, people may not want to own a house, while they may still be interested in real estate. So here are some stats from the US, since, again, like Bani mentioned, that we are today in our evolution in real estate and the financial sector associated with real estate, something similar to what was happening in the US in the 1960s and 70s. Today, after the GFC, housing supply in US has been very low. And why is that? Because the private equity funds own most of the houses. Now, you'll always need houses to stay. We are at 140 crore of population. It is only growing. So houses will be required, but probably institutions and large corporate developers who have the capital will own them. And also probably housing sector will also get into a rental yield model as the sector institutionalizes and as the underlying becomes more standardized. When I say standardized, what I mean is that in commercial real estate, why you have REITs that were possible in India was because the underlying per se, grade A building is a grade A building. It has certain specs. Grade B building is specs. Now, if you look at the financial sector, why do you have currencies? Currencies are standardized. So you have multiple currencies, you have more liquidity. The moment residential gets into that, probably you'll have just instruments pertaining to residential real estate as a method of diversification. As simple as that. And that's how the market may evolve.
No, couldn't agree
No.
more. It's already come into Asia and it's already there in China, Singapore markets, and in India more in the form of student housing and some service residences as we call it. But sorry, Bani, you were saying something on the same.
No, I was completely agreeing with what you'd said, and like, if we see, it's the bottom of the pyramid, even in the housing demand, that has not been addressed yet. And the reason it has not been addressed yet is because we have not been able to make the numbers work, right? I can't go to a tier 4 city and develop there because somehow the math of that project just does not make sense for me. So now, pretty much since the time that we got independence, we've been focusing on, the government has come out with numerous initiatives, whether it's the Indira Awas Yojana, whether it's JNNURM, whether it's Rajiv Awas Yojana, which was just for slum rehabilitation. It took another 15 years since to come out even with the PMAY. But I feel like when it comes to serving tier 3, tier 4, in the next 7 years, if we are looking at consistent inflation, we are not going to be able to do it. It just won't make sense for us with finance costs as high as they are. I think it is going to be the government that's going to be doing that housing. Because we will just not be able to make sense of it. The weighted average cost of capital for us as real estate developers is too high. So we can't serve that part of, the pyramid, which actually is in the dire need of housing.
Fair point. Sarah, you had a point. I think you raised your hand.
Yeah. So basically, I think I'm just picking up the point from Anjana about the cost and implementing sustainability. I think I beg to differ because I think cost can be optimized elsewhere, because more than a choice, it is the need of the hour to actually implement sustainability, because the faster you do this, you then become a differentiator with your competitor and you start implementing ESG in your system. Say, suppose in the residential apartment, if you have like one or two, when the customers are coming to buy these kind of units, if you have just one or two, the EV charging, and they're not happy because they actually want something. So that's the whole idea of ESG, to actually say that I am going to now focus on certain aspects of taking things that are going to make my customers happy, the end user happy at the end of the day. But with urbanization, yes, there is some amount of destruction to our environment, and that is inevitable. But I think it's more of a conscious practice and increasing your ESG strength. That's my point.
Interesting. I think we lost the Nissa. I had query for her. But let me go back to Hina. Hina, real estate industry per se, private equity money, about 5 billion annually, what we've been tracking per se. And it's been a little bit of a dip since, early 21. It used to be $6.5 billion. What do you think could be done to attract more money in this space?
Transparency and governance. I think a lot of money that was raised through funds, has not yielded the returns, and the payback of capital has got delayed because of whatever the sector was going through in the last 3-4 years. So the moment we have more transparency and again more instruments, more accountability, that's what's going to attract more investors. We have to make residential real estate also something similar to commercial real estate.
So on the Resi front, Bani, again bringing you in terms of aspirationally your first Resi REIT that you plan to launch some point in time.
Yeah.
What
sure.
kind of yields do you think today when we look at commercial, for example, it's about say 8ish. When we saw the Nexus REIT that came in, it was about 8.1% pre-tax. So these did attract fair amount of capital and they all got oversubscribed. So in Resi, where do you think would be a sweet spot for a retail investor in the HNI segment to look at it?
I honestly have no idea because there is no proof of concept. I cannot even look at the Asian markets and say that this is an average that we can ascribe to and say this is what we're going to get. I think whoever comes is going to bet little blindly and hopefully make a killer return. But yeah, I just want to say as a developer, there is no scope for further governance and transparency. I think we have crossed that point. We cannot do better. We cannot do more. I think institutions just need to, have the gall because, when they are controlling money and the project gets delayed because it is in the interest of, we're serving the interest of the institution and not the customer, then all the RERA liabilities come on us. So I don't think there's scope for more governance or anything to do better. I think this is the max. Anything more and nobody's going to want to do this anymore. So but that being said, I really don't know. I don't like opining on things I don't have any data on. So let's see. We'll see how it works. I want to see how the kids who are 16 17 today, what kind of money they're going to be making later also, because the average 16 17-year-old today wants to be a gamer. They are not looking at engineering. They are not looking at conventional job options. How is that going to evolve? How is the digital economy going to evolve? This is just for us to see. We have no idea. So I think the next 10 years will be very telling of where we're going. But if you ask me personally, what we're doing today at ATS, I see it only as a 15-year game and not beyond that. We will continue to do real estate. We'll just do it differently. But what that differently is we are yet to figure that out as well.
Interesting. Sarah, on the commercial real estate front, as service providers, sometimes we get a lot of flack from the development community that we need to educate the occupiers that annual escalation or a 15% after 3 years doesn't work. It doesn't beat the inflation. What's your suggestion? I mean, because it's more of a, like Bani said, from a retail residential REIT perspective, that somebody will bell the cat, will probably make exponential returns. Similarly, in the commercial real estate, it's more of a space wherein it's a me too mentality, right? If everybody is at a 15% after 3 years or a 5% annually, it's very difficult to change that mindset of an occupier because he has options.
Yeah. So I think when I'm just talking from an investor perspective, especially when you have this ESG in place, like if you, you can't go beyond a certain, like you said about that 15% and all of that. But I kind of think it is more about giving, like the social, if the company has a better social governance perspective. Basically, they have to talk about the employees being treated well and the employee systems and the organization culture, because then you retain your employees and you retain so when you choose your tenants, you make sure that it's not just the infrastructure, but it is also about a company that is actually going to stay for long. So that also matters, because if they are not able to hold on to their people, then I think the company is going to collapse. Yeah. And also about the governance, I just want to make a point, because there are commercial real estates projects in Bangalore that I know of, where they've actually gone beyond measures to actually reduce the traffic around that community and go over and develop a flyover, which then makes it easy for the environment around this particular project, and thereby easing the whole system. So it may be, from pockets of what they could contribute, but it does help the community at large.
Oh, thank you. Reshmi, bringing you in, institutional capital have now taken development risk also in the country. Do they understand the applicability of premiums which could, impact the return on capital? Because the premiums across the nation, every state, depending upon the development plans that have been announced, have probably become exorbitant. Bani said the accountability in terms of, the governance and the reports and the submissions and the RERA compliances is literally a sword hanging on your neck. So how do you...
So when investments are made into real estate, they go with a certain set of parameters and the current rules and regulations. And so they do take into account all the premiums that are applicable, etc. At some point, if the values fall and the costs go up, that's when the developer lobby starts, liaising with the government to give them some SOPs like the stamp duty reduction, premium, reduction in premium for certain time. Like you've seen the cluster development premiums have been reduced to 50% for the past 1 year. Some of these can revive projects and bring in more financial viability. And it's a continuous process. At no point can you say that this is what the numbers are going to be and this is what the cost is and these are going to be my returns. So people take that risk when they enter into a project. They do buffer, into some of the profit margins, etc. But they are also aware that over a period of time during the lifetime of a project, they would be able to get some benefits with the help of the government. And that's what's really turned some of these projects around. And the government is also very understanding of the issues faced by the developers. And they have really stretched themselves over the last few years to help them make these projects financially viable.
Quite interesting. Hina, on the funding side again, when you've raised 700 million in your career per se, and I'm probably $1 billion now. I wouldn't know, but I'm just saying.
Actually, I deployed. I didn't raise the money. Okay, someone else raised it. I deployed.
Somebody else raised it. Now, but when you go to raise it, I'm assuming you'll have a perspective on the other side of the coin. What do such investors ask for in terms of queries in the real estate segment when it comes to the AIF or today in the fractional ownership? Even with the 10th, your present organization and your previous organization did do a lot of distribution for real estate, whether it was in the form of NCDs or today in the form of fractional ownership of real estate. What's the kind of queries they look at? And like you had mentioned, the returns haven't come back. The money never went back to them, which kind of led to a
money. Yeah, a lot of it was delayed. See, the standard questions, they want to know about the track record, of course, of the fund manager, the sponsor in getting the money back on time with adequate returns, the promised returns. So that's standard, that's there. Then also they look at relative returns. Okay, you may have India focused investors and you may have global investors. When it's global investors, then it's more a portfolio or, again, an asset allocation or capital allocation strategy vis-a-vis different countries. So if my dollar return is already at 15-16%, why would I want to take a rupee return at 18%? Let me put it that way. Additionally, I'm taking a currency risk in a depreciating currency. So that also in the last few years has been a drain on, the FDI that's been coming into India. Because when a lot of global capital actually came into India, it came at different rates, probably at 40, 45, 50, and it has largely been a one-way move. So if you got caught on the wrong side of the cycle, even if you made money on the underlying and the project had done well, you lost on account of currency because it was just a bad time when you got into the capital. As simple as that.
So like Sarah mentioned, the last 5 minutes are left. Maybe one question each with one word that comes to your mind as this thing, which was from Sarah's suggestion, right? So Sarah, I'll begin with you. High rises or row houses in Bangalore?
High rise probably, because from builder's perspective.
Builder's perspective, of course. Reshmi, to you, returns last decade versus the next decade?
Returns the next decade.
Next decade? Okay.
Yes.
And Hina, fractional ownership of real estate or REIT?
REIT.
REIT. Okay. Anjana, for you is, which is the most promising RE sector? Today, of course.
Oh, I think, wow. I think mixed use.
Rapid fire, you don't get so much.
I think mixed use, yeah.
Okay, mixed use, a fair answer. And we have Bani, under construction or ready property. What would you advise an investor to buy?
Launch stage with a trusted developer. Maximum return. Yeah. Not even under construction. Literally at launch, sit on it. It takes about, like, if you look at it even from historically, it takes 7 years of gestation in real estate to make real money. So let us assume that's start to end. So at the launch stage with the trusted developer is the best time to buy and sit on it till possession, or a year after possession rather, when people have moved in.
That was a long answer compared to the one word we were looking at, but we got the perspective of the launch stage. No, thank you so much. Not to take too much time, I think it was a very interesting conversation. Anjana brought in the sustainability lens with green spaces, the importance of amenities and communities in a sustainable development per se. And of course, the cost of money to do these development versus the returns aren't justified today. But I think Bani said that, Sarah said that cost optimization can happen, which is a possibility. Greenfield versus brownfield, very well explained in terms of where you could do a core or a core plus strategy and where the returns are. We had Reshmi, who of course brought in the entire transition that happened over the last 3 decades that she's been seeing in the industry, the tech and the institutionalization, and of course the other asset classes which have gained prominence, whether it's data center, industrial logistics as a platform. Bani had a fair perspective in terms of, how as a family they saw green developments always from a perspective of where would, Gautam would have wanted his children to go up in terms of green development, sustainable green projects, and, low density, even though in a low density project, the returns on capital is not that high, but it kind of leads to the sustainability commitment and the fintech, and hopefully your SE REIT first, which we all subscribe to in a couple of years from now. Hina, you gave us a good perspective on the, how the market kind of evolved. And of course, a lot of investors haven't got their money back, and which has kind of led to not it being one of the most attractive investment class as an instrument per se. But very interesting statistics that 33% of AUM from North America is led and controlled by the women there. And of course, we don't have Nissa, she is locked out, but a good perspective on the fractional ownership of real estate and how broadly capital, whenever it's generated, either finds its way into gold or real estate. With that, I end the panel and thank you, my fellow panelists, for an insightful conversation.
Thank you, Gautam.
Thanks,
Thank you,
Gautam. I
Gautam.
think that was a very,
Thank you,
fantastic
Gautam.
summarization of all the, the discussion that we had. And I hope all the speakers passed your test paper at the end. So,
Yeah.
so we have some audience questions as well. And, Gautam, I'll bring it to you, and you can decide what speaker should take that question. One of the questions that have been asked is about the JVs and consolidation. So, how are listed developers looking at inorganic growth through JVs and consolidation? Gautam, up to you, who should take that question?
Sarah, you want to give it a shot as a listed developers in JVs and consolidation?
Yeah, so basically, JVs are preferred, but it depends on your JV partner at the end of the day. And if you're able to raise, the capital, then I think it's the best way to, take the other one.
Okay, fantastic. Gautam, you want to add something to this? You must be seeing a lot of these things happening here.
No, I think I would bring in that perspective that the JV and a consolidation from the perspective today is very different from the way it used to be earlier, because now you are as accountable as a joint venture partner. So choosing that partner becomes extremely critical, because the regulatory framework from a compliances and jail time is something you want to avoid. So it's broadly that space.
That's right. And our next question that we have got is on that, about insolvency and bankruptcy. Has that brought accountability in the sector overall? How is that working out? Whoever would like to take
definitely has, but I'll give it to Hina from NCLT perspective. What do you think has been?
Well, the stats that I recently read was that in the real estate sector, IBC has just resulted in 10% of resolutions. So compared to other sectors, it's been relatively low. Having said that, the sector is cyclical. It's very, very cyclical, and illiquidity of the asset is very, very high. So resolutions will not be the same as they are across different industries. But again, yes, IBC has definitely brought the borrowers as well as the lenders to the table, where they are trying to resolve the matters. So there is progress. Probably earlier it was 0. Now it's at least 10%.
Yeah, it's on the positive direction. So yeah,
it's moving positively. Yeah.
And what about the financial discipline among the developers? Internal financial discipline. Gautam, have you seen that increasing in the past few years?
No, most definitely. Like I think the group was debating because of all the compliances, regulation, there are website where you need to put in your data there, the escrows that you need to maintain. You do whatever financial engineering you want or something, but you're constantly under the watch. So it's definitely improved. The discipline is far better than it used to be earlier.
Okay, fantastic.
I just want to add on to that, but women in real estate handle the financials, in a better manner. I'll take it that.
Any day.
So I think we should see more CFOs of the companies as a woman, because yes, woman has that, the background of being very good money managers, whether it comes to home or work. But I think this was one of the very interesting and very informative panels where we spoke about not only about the finance from the investor's point of view, from the developer's point of view, but also about the trends of how the jobs are going to look like, how the generational shift of the new generation looking at the kind of jobs they might be taking, and the repercussions or the cascading impacts on the investment in real estate that we are going to see. So a lot of I think very fluid state that we are in, and I think a lot of changes that we are going to see. This discussion was, I think, just the tip of the iceberg of what redefining of real estate and its investment that we are looking at. So thank you very much, Gautam, for that wonderful panel discussion, for to all our speakers as well for joining us here, Khair for joining from Dubai and being part of this session, Reshmi, Anjana, Saraf, Bani, and Hina for being here with us and being part of this very fantastic discussion. Thank you all so very much.
Thank you.
Thank you,
for having us.
It was our pleasure.